Welcome back to Trading 360. I'm Nicole Penelides. It's time for the big three. Three stocks, three charts, three trades. Ben Lichtenstein will take us through the charts. Here to take us through the trades, Alan Nuckman, Chief Market Strategist at bullseyeoption.com. All right, great to see you both. You're at the CBOE today. Very busy there, Alan Nuckman. Your first name on the radar here is Sunrun. Why is that?
Well, there's a theme for today, and I'm going to point out to my friend Ben that we've been in a buy-the-dip market. So we've had a little bit of a pullback, I would say a pause, a little bit of a summer break, and so we're holding on here to the overall trend, but we pulled back in some of the big-name stocks. The high flyers are all about 5 or 10% off their highs, but the S&P did rally 5% in the last 2 weeks of August for a little bit of a heat wave there. Right now, we're at the halfway point of that August 18th swing low to that September 1st high. So to get into the macro market, I'm looking at some stocks here that have not performed. Sunrun's 50% off its January top. It's been bottoming out here between 15 and 25 for the last, since March anyways, and then tightening, consolidating between 15 and 20 here in the last couple of months. A breakout of that range targets 25. I'm also seeing my bullish divergence, meaning we made new lows but not new highs in implied volatility. That's a signal of a turn. And I'm also seeing leverage buying. So there's a lot of options buying, and that's the smart way to play, tying up less money. So I'm looking at the January 10 call. Again, the low is underneath this 15 level. The 10 calls trading about 5 right now, 5.50. It's $4.50 in the money. It's got 4 months of time. And if we get to that 20, just that range top, once again, that option gains 100%.
I see. All right. So at this point, feeling bullish, a buy the dip mentality. Ben, your turn. You're up.
Well, I'm not sure if I would describe what we've seen around 15 as bottoming, considering we just traded down to below 14, but possibly, again, for me, it looks more like the trends to the downside still. You can see it here on the intermediate, or I should say more granular 5-minute time frame, and then we can get into the more intermediate time frame. But taking a look here at the recent move we've seen basically this week from 16 all the way down to, again, I mentioned we just traded below 14. Here it is $13.99. We're off that low here, but no indication that we've rejected the working assumption that value is moving lower, and that occurs here, Nicole, on multiple time frames. Taking a look first and foremost at the 5-minute candle chart, you can see 3 areas here right now. We've actually gone vertical to the downside, so the bears are looking for a new area of consolidation to form below this $15 level. Let's take a step back from this 5-minute candle chart and get into the hourly. And you can see, again, another example here. We're going back to, well, a few weeks ago when we were trading up around that $24 level, and you can see 3 areas on the way down, 23, 19, and currently balancing around 15. So we're referencing that $19 level as long as we're holding below, again, the last area of balance prior to the one that we're currently forming. Then we're still have that, a valid working assumption that we're trending and forming areas of value to the downside. Let's show you why. Again, I'm still sort of leaning on this bearish narrative here. It's not just the 5 minutes, not just the hourly candle chart. Here we're looking at a daily candle chart, and this goes all the way back to, we're talking 2020 when this stock, RUN, was up around 100. You can see how the sun has been setting on shares of and the areas of value that have moved at lower and lower levels here along the way down. And again, I think that we're starting to form something here around the $15 level. Just don't see that bottom pattern forming that Alan identified here as of yet. I see areas of value moving to lower and lower levels.
Right, understood. So he's watching this. What do you think, Alan? What do you think of Ben's comments there?
Well, I'm comfortable being long from 10, and that's the strike price, and having 4 months of time, and looking to see how this bottom bases and bounces. So my indicator that I use, this cash flow indicator, this money flow indicator, is telling me that someone has some interest and is accumulating some options in this, and that's a bullish sign. So I've got that, and I also have that bullish divergence in the fact that it made new lows, but the volatility is lower than it was previously when it made new lows. That's a sentiment shift sign, and that's what I look for, and that's why I use options 3 to 6 months out to be able to gently find that bottom. I'm not finding the direct bottom. I'm finding a gentle bottom.
A gentle bottom. I like that. That being said, let's turn our attention over to AT&T. Used to be a darling, and now not so much. Tell me about this name in telecom.
Okay, now this is boring. All right, this is ridiculously boring, but it's about risk reward, and it's money that's out there. So the PE in AT&T is 6, so it's an inexpensive stock. We can all agree. So it's down here at the lows. 1343, I think, was the low for the year. The last time this stock was at 13, okay, was 1993. That's when Ben and I were little traders, little tiny kid traders back then, 1993. And so looking at the risk reward here, this is a stock that also has that bullish divergence, meaning it made new lows but not new highs, implied volatility. It also has options accumulation, so people are positioning here. It's been between 14 and 20 for the year, so 17 is kind of the midpoint pivot there. It's been between 14 and 16 for 2 months. A breakout of that range targets 18. All right? It's 30% off the February top where we were just at $20. So, again, not to say that a stock can't go lower and buy. You're not buying it just because it's low. I'm buying it because I have the technical setup that I like. Now, the best part is this boring way to play it, an in-the-money option. I could say, listen, I want to buy it when it gets to 13, put in a limit order, and wait and wait and wait and wait. Or I can buy the $13 call here for January. Not January of 2024, January of 2025. That's 498 days. I have the right to be long from 13. That's trading for about $2.50 right now. That's $1.75 in the money. So the expiration break even is 75 cents. And that's a lot of time. That's a lot of time, people. That's 498 days. Now, for this stock to just get up to 1650, we talked about 17 as the midpoint and 18 as the breakout target. If it gets up to 1650, this option gains 100%. So it's ridiculously boring, but it's an amazing risk-reward play.
Look, people like boring trades and boring portfolios. They feel like it serves them well over time. And, oh, you mean time. I don't think we've had a guest on who put a trade out to 2025. I mean, that's some time right there. I mean, the company still sees its expansion in 5G and fiber net ads and all that. But right. Ben, your thoughts on the chart?
Nicole, I've learned over the years that if it is boring trading, that is, then you're doing it right, basically. I wish I'd known that when Alan was talking about us as wee little traders back in 1993, because I was always looking for the excitement, right? The grab the bull by the horns type trade. But in this instance, we're still trending to the downside, and that was the other lesson that I've learned over the years, is that the trend is your friend, and you can see it very well defined here. Again, areas of value that move lower and lower to lower levels. We're going back to May when, we were trading April up around the $20 level, and you can see areas of consolidation, a very well-defined trend to the downside, and no indication here along the way that we've rejected that working assumption that, again, we continue to form values and seek value at lower and lower levels. Currently balancing around 1440, 1450 area. Let's take another step back away from the 4-hour candle charts here. I want to show you because this is playing out on the longer term as well. I've got daily charts here, and this goes all the way back to the end of 2020, beginning of 2021. Shares of AT&T were trading up around 26, and you can see in this instance 3 larger areas of consolidation that are forming. Again, this newer one, a bit immature at this point, but definitely a recent breakout here, and no rejection of this lower level, I think, is the real takeaway here. And then this chart points to, again, that longer term time frame weekly candle chart with a double top that played out up around 33 back in 2016, 2017. And then again, areas of consolidation at lower and lower levels, and no rejection of this lower level as of yet, and no indication that the working assumption that we're seeking value and continue to establish areas of value at lower levels is an invalid one here. It's pretty simple at this point here. That's the other thing I learned, is less is more when you're talking trading. Keep it simple.
Yeah, and this one really is keeping it simple, because after 2025, you got some time for this trade. Last but not least, when we look at Nutrien, this name has been under some pressure. Barclays had a double downgrade after the earnings in August. What are your thoughts here, Alan?
Well, I just trade what I see. And this is a stock that's been between 50 and 70 since June. 60 is this midpoint pivot. We popped above that, so that should usually send us up to the range top at 70. It's 50% off the 2022 high as we stand right now at around 62.5. But again, we have the same thing here, this bullish divergence. It made new lows, but not new highs in implied volatility. That's the emotion. There's less emotion. And Ben's going to agree with me. You always try and eliminate emotion. So when you see less emotion on the lows, that's a positive sign. You're also seeing this leverage buying. That low is around the 50 level or so, but I'm looking at the December 55 call. So because this is a more expensive stock and the volatility is a little bit higher, I've got to go deeper in the money here, and I'm buying less time. So there's always a balance. You can see in AT&T, there was a huge amount of time because the volatility is so ridiculously low that you can position yourself and buy a long time. Now in this option, it's got about 3 months of time. We're trading about 9 or so. It's $8 in the money. And if it just gets to that range top at 70 once again, that option gains about 100%.
Okay, and that's what he's betting on. Some big news there on the bullish side of things. Ben?
Well, I can see the short-term bullish narrative here. We actually have been trending higher on the more intermediate hourly time frame. You can see the candle chart here I have behind me, and you can see the three areas of consolidation that have formed. Alan's talking about the $70, $71 level. That's actually the upper extreme of the range that we're currently in. Get back up above 65, and we open up the door for a retest of that level. You can see that we're forming value, again, at higher and higher levels, but this is an hourly candle chart, and this is actually the most bullish scenario that I can see on this stock. And let me show you here, when you look a little bit more closely with that fine-tooth comb, I actually see potentially a bearish setup that's playing here. We have areas of value moving at higher and higher levels, but now we've broken down, and are we starting to balance out around 62? It looks like it to me, down from 67. Yeah, still above 59, which I think is the line in the sand. Again, if you kind of look at this as that bigger picture, upward trend now starting to potentially roll over, that's going to be the key area to watch. But let me show you, because again, that's about as bullish as I can get here as the hourly time frame, and even in that latter scenario, it's not very supportive of longer term gains here, because taking a look at the longer term trend here, Alan was talking about trade what you see. Again, that last instance, maybe not as clear as this one, right? A very well defined trend lower from 85. We're talking back in January, February of this year, all the way down to 52. Recently more sideways and overlapping, consolidating around 60, but as long as we remain below 72, you can see that that was the prior area consolidation that formed relative to the one that we're currently forming. This is still in a bear trend. You can also see a bit of a double top that formed right here, so that kind of coincided with that 72 level, and that's the other thing that, Alan, that I like to point out here is I like to trade with the trend, right? And so this is sort of why, because the trend does the work for you in many instances. It doesn't spend a lot of time against you if you're positioned properly with it. And here you can see the retest of that 72 level. Yeah, it didn't feel comfortable when we were there, but it didn't take out anything significant. And so again, if anything, it poses another sell opportunity. Let's move away from this time frame, because we have one more for you where, again, another instance where, yeah, that intermediate time frame to the upside, trend to the upside has been kind of invalidated by this longer term. Here you go. We're going all the way back to the spring of 2022. Last year, we had April levels up around 117, and then you can see again these areas of consolidation currently balancing around 60. Alan, I see what you're talking about in terms of the significance of this 70 level, but if we take out 60, I've got my sights more set on 50 down here, the lower extreme of this range.
All right, 1993, you're cooler now, guys, and you have a lot more experience, wiser. I appreciate all of your insights here on the Big Three today. Alan Nuckman, Ben Lichtenstein, thank you both very much for the Big Three. Coming up next, we're going to spotlight Disney. The company, of course, is in a carriage dispute.